So in this lecture part, we are going to talk about what are financial statements. We have learned so far there are three financial statements that we have talked about. One is the balance sheet, other is the income statement, and the third one is statement of stockholders' equity. And then we talked about a statement of cash flow, and then we're going to talk about all of those equations in a minute. So the balance sheet is that reports your assets, liabilities, and stockholders' equity. These are basically uh, permanent account. So financial statements are business documents that use to communicate information needed to make business decisions. These and this information is as important for the people who are working for the business and also other partners or vendors, or the word is stakeholders. The word is stakeholders. Stakeholders is everyone is included in the business. It could be employees, owners, stockholders, vendors, customers, banks, anyone who is doing business with the business need that information. So balance sheet reported at a point in time means as of December 31st, 2020, balance sheet tells you how much assets you have, how many liabilities you have, and what are the stockholders' equity. Income statements gives you the results of operation from a given period. So that means from January 1st to December 31st, how much results of operation, how much revenue you have, how much expenses you have, and if there is any gains and losses. So it gives you the information about all the revenues and all the expense. So reports net income or net loss. So revenue minus expense is equal to your net income. So it gives you all the information about the revenues. Revenues are increase in company resources from providing goods or services, and expenses are decrease in resources for providing. So always remember, revenue increases equity in the business, and expense decreases equity in the business. All right. Net income results when revenue exceeds expenses, and net loss when expenses exceeds revenue. All right. A statement of stockholders' equity. It reports event that causing an increase and decrease in company's stockholders' equity during a given period. Reports how the company's retained earning balance changed from the beginning to the end of the period. Again, I talked to you earlier that you have a retained earning. It has a beginning balance. You add the net income. If you have a net loss, it will go over here. If you're paying dividend, it will go over here. And then it will tell you ending balance, how much revenue, how much earnings you are retaining or keeping into the business. The stockholders' equity consisted of two parts. One is the contributed capital, contributed by the stockholders, which comes in the name of common stocks, preferred stock, additional paid in capital, and things like that. Earned capital is basically your retained earnings. So there are two kinds of capitals: contributed capital and earned capital. Earned capital is your retained earning. Contributed capital is our common stocks, preferred stocks, and additional paid in capital. Some companies have a separate statement of retained earnings, but most include retained earnings as a part of the statement of stockholders' equity. So you can do it either way, it doesn't matter. So why do we prepare financial statement? That's a very good question. The purpose of financial statement provide information about the results of operations and financial position and cash flow of an organization. Cash flow, which one is provide? A statement of cash flow. that we have discussed in the previous chapter, statement of cash flow. All right. This information is used by the readers of the financial statement to make decisions. For example, the bank is going to make a decision whether they want to lend the money to this business or not. Income statement informs the reader about the ability of business to generate a profit. Whether the business is profitable or not, you can find this information from the income statements. When received over multiple time period, the income statement can also be used to analyze trends in the company information. For example, you can download the last 10 years of Walmart income statement from SEC websites called Edgar, and you can do a trend analysis and see whether their income are increasing or not. Purpose of the balance sheet is to inform the reader about the current status of business as a date listed on the balance sheet. Means how many assets the company has, what are the liabilities, and how much equity is in the business. A statement of cash flow show the nature of cash receipt and cash disbursement. It tells how much cash came into the business and what the business did with this cash. Means how much cash was paid to make an investment, how much cash was paid as a dividend. These are the information we get from. So I would suggest please make sure you read this piece of information. Why do we prepare financial statement for multiple time? Because this is sort of a question you may get in an interview in future when you apply for. Even it doesn't matter whether you apply for an accounting position or not, they could ask this question. I mean, it's a fair question for any business interview. The relationship among the financial statement, the financial statements are relate to each other. All right. So for example, so you have an inventory, right? Inventory is an asset. So it stays into the balance sheet. Here is the inventory as an asset, and here is your income statement. Once you sold this inventory, it goes on the business income statement as cost of goods sold. So inventory not sold yet is an inventory. It's listed on the balance sheet. Once it's sold, it becomes a part of the cost of goods sold. Net income from the income statement used to compute ending retained earnings on the statement of retained earning. Classified balance sheet places each asset and each liability into a specific category. Assets are shown in order of liquidity. For example, cash, account receivable, and then inventory. So cash is the most liquid, account is less liquid, and inventory even less liquid. Liabilities are classified as current, means due within 1 year, or long-term, due after 1 year. Liquidity measures how quickly and easily an account can be converted into cash. So as you know, cash is a cash, and account receivable can be converted into cash, but not as quickly, and inventory even take less. Current asset will be converted to cash, sold, or used up during the next 12 months or within the business operating cycle. Operating cycle is the time spent, such as a year, 12 months period. Cash is used to acquire goods and services. Goods and services are sold to customer. The business collects customer from the cash. So this is basically a operating cycle. Long-term assets are all the assets that will not be converted to cash or used up during the 1 year period. So for example, your buildings, your automobiles, your planes, your land cannot be utilized in a year. They have a longer shelf life, more than a year. Long-term investments are investment in bonds or stock that the company intends to hold for longer than 1 year. The next thing we're going to talk about property, plant, and equipment. Another example of long-lived tangible asset used in the operation of the business, because property, plant, and equipment are nothing but your factories that are producing products for you to make a sale. Intangible assets are assets with no physical form. They are valuable because of the special rights they carried, such as franchise, trademarks, royalties. These are the examples of intangible assets. Current liability must be paid either with cash or with goods or services within 1 year or within operating cycle. So it's like accounts payable, salaries payable, unearned revenue. These are considered the current and current liabilities, the same meaning. Long-term liabilities, the liabilities are due beyond a 12 months period, and that's why they are called long-term liabilities. A stockholders' equity represents stockholders' claims to the assets of the business, because as you remember, equity is asset minus liability. So once you sold all the asset, paid off all the liabilities, whatever left is for the stockholder. It represents the amount of assets left over after the company has paid its liabilities. Ending common stock, retained earnings, total equity from the statement is stockholders' equity shown in the balance sheet. Ending cash balance on the statement of cash flow is shown as the beginning balance of the next year. Okay. The income statement is statement of stockholder, and a statement of cash flows report activity for a period. The end of period balance sheet reports the company financial position at this later point in time, basically as of December 31st. Okay. So in this chapter, we're going to stop here for this lecture. What are financial statements? In the next lecture, we're going to talk about how to prepare the financial statements.